So starting with the discussion for the security analysis, in that we are going to have learning of basically three aspects. First is a fundamental analysis. So we are understanding security analysis. In that we are going to have understanding, these are the concepts which are very much connected with the portfolio management. We are going to understand fundamental analysis. Second, we are going to understand technical analysis. In that, what do we understand with the technical analysis? What is its meaning? What are the assumptions of the technical analysis? The theories and the principles based on which the technical analysis is done. And there is a concept called charting techniques. Third, that we are going to understand is efficient market hypothesis. Basically, efficient market hypothesis we already have done in the portfolio management. The same thing as what we are going to discuss over here as well. So let us understand it. Investment decision, that is capital budgeting, depends on the securities to be bought, held and sold. So over here the investment decision is about the investor. So investment, that is a decision of any security, is when to buy, whether to hold or not, and when to sell. Buying of the security is based on highest return per unit of risk or lowest risk per unit of return. We understand that there are certain measures, like we have the coefficient of variation criteria that indicates that what is the risk per unit of return. We would like to reduce it so far possible. We take the decision using the alpha, wherein we understand that whether the security is outperforming the market or not. Selling security does not depend upon any such requirement. We understand that the selling of the security may be because of the two reasons. One is the reason that you are in need of funds. Then in that case, of course, you have to sell the investment, even though the investment is lucrative. However, if at all the investment is not lucrative, that is the other reason for which you are selling the security is that you churn your investment. You sell the existing investment and you are going to buy like a new security. That is what the two reasons because of which we go for the selling of the security. A security considered for buying today may not be attractive tomorrow due to the management policy changes in the company or economic policy changes adopted by the government. So we understand that whatever the investment that we make today, it is not like that that investment opportunity is going to be lucrative every time. There are definitely the circumstances that changes, and because of which an investment that you have made may not be so lucrative. That is the reason you may have to sell that investment and you are required to select a new investment opportunity. The reverse is also true. Means an analysis today says that certain company is not good for the investment today. However, there are fair chances that the same company would become attractive tomorrow. Therefore, the analysis of the security highlight the portion is on continuous basis is must. So basically, we understand that the analysis of the investment opportunity is a continuous process. It is not like that the one time you make investment, yearly you make investment, or half yearly you do this exercise and that's it. It is a continuous process because the capital market situation keep on changing. Security analysis involves systematic analysis of risk return profile of various securities, which is to help a rational investor to estimate value for a security from all the price sensitive information or data, so that he can make purchase when the market underprices some of them and thereby earns a reasonable rate of return. So in security analysis, what you are going to do, you are going to have a systematic analysis of risk return profile of the various security which will be required to make the estimation about the price of the security and all price sensitive information on the data. Friends, we understand something like this in a very simple language, that a company which is dealing in a specific industry, let us say that's a company called Ranbaxy dealing in pharma sector. Now considering the scenario in the market, considering the scenario in the all over world, it is likely that say, the pharma company is likely to have say, the boost in a situation like COVID. So considering this situation, you may select an investment opportunity in pharma company. We understand that say, the banking scenario is changing. It may happen that say considering the recent changes, say there are fair chances that say, the number of NPAs are likely to increase. Then in that case, say, the banking stocks are not something say which are lucrative. So whatever this kind of information, for that say you're required to keep a track, and based on that say you're required to make investment. Two approaches, namely fundamental analysis, second technical analysis, are in vogue for carrying out security analysis. So both of them are appropriate so for the purpose of carrying out the security analysis. In fundamental analysis, factors affecting risk return characteristics of the securities are looked into, while in technical analysis, demand supply position of the securities along with the prevalent share price trend are examined. So basically, we understand something like this. Like, I give you an example for the fundamental analysis. We have studied a kind of certain formulas in this way. Ke is equal to d1 divided by p0 plus e. Now, if at all I simplify the formula in terms of the price, so it is k minus e is equal to d1 upon p0, and p0 is equal to d1 divided by k minus e. What does it mean? It means that say the current market price of the equity share is calculated as so the future dividend income which investor is going to receive is discounted in present value term. That is the way we make the calculation of the P0. Now this P0 is considered to be the fundamental price of the security. This price of the security takes into account the earning of the company, earning into dividend payout ratio. That gives the amount of the dividend, means so the dividend policy of the company divided by cost of equity, means the risk which the security has from the investor point of view. For that, so one of the popular model that we always study is like the CAPM. It is RF plus beta into RM minus RF. So the risk of the security is taken into account, minus growth rate, it is B into R. B stands for retention ratio. So again the dividend policy of the company is taken care of by the formula, and R stands for the rate of earning of the company, that is the efficiency of the company to earn from the business. So if at all you think logically, then in that case say all the fundamental factors are taken into account for the purpose of making calculation of the fundamental price of the security. Now whatever the price that say we compute over here is required to be compared with the price which is prevailing in the market. Based on that, say you decide whether the security is underpriced or overpriced. If it is underpriced, you buy. Overpriced, then you sell or you do not buy. That is what say we understand is in a simple language, say the fundamental analysis. In technical analysis, I can give you some example like this. Let us say that say we are making computation of, and that is we analyze the chart, and based on that say we take a decision whether the security is supposed to be purchased or not. See, this is only one example that I have given to you for fundamental analysis, but of course the concept does not end over there. we have number of valuation methods. Basically, the chapter that we have called corporate valuation, the chapter that we have is the security valuation, the chapter that say we have of the mergers. In that say we focus on this valuation aspect. We do the valuation based on like the book value method, net asset method, valuation based on earning capitalization method, then present value of the future cash flow method. Like that, say there are a number of methods by which say we make the computation of the price, and based on that, say the current price is calculated. That current price is compared with the price which should prevail. That is, that price is compared with the actual price to decide whether the security is underpriced or overpriced. So of course we understand that say every time the conclusion is not going to match, because all the different methods that we have for the valuation is going to give the different results. So that price and the price which is prevailing in the market, always say there is going to be a variation if at all we adopt the different methods. Coming back to the point once again, I'm discussing something about in terms of the technical analysis which is referred over here. Of course, that we are going to discuss later on in detail. What happens that say the price of the security is, let us say, moving like this. Let us say that it moves in this way. So basically what happens that's over here, on x-axis I'm taking the time period, and on y-axis I'm taking the market price of the security. Now what happens at basically over here, in technical language it is given a name as support level, and this is given a name as resistance level. Support level means that the market in total has a kind of notion that so the price of any that is say this security, let us say that's a particular we are talking about a security called TCS. Now the price of the that is say TCS should not fall below this. So when the prices are falling down, falling down, falling down because of any reason, there may be some negative news with respect to the IT sector, there may be some negative news with respect to the TCS. With that, so the price of the security is falling down. However, once it is reaching to this point, everybody believes that say, in spite of this bad news, of course the company is not having a worth less than this. So what happens that say generally, so the investors are going to buy the security at this point of time. Number of buyers are exceeding so the number of sellers, and because of that, so the market is going up. When the price reaches to this stage, then like in general there is a notion that say the price of the security say should not be exceeding this price, in a way that say the security is already overpriced at this point of time. So what everybody will do, everybody will start selling the security. So the number of sellers in the market is exceeding the number of buyers, and because of that, so the price of the security start falling down. So technically, so there is a resistance level. Resistance level means you can understand logically that say there is a resistance that the price of the security cannot go beyond this. That is called resistance, and this is what we understand is a support level. Support means that so the price will not fall below this. That is a support price. So looking to this kind of trend, let us say that so the price of the security is at this point of time is this price. Then in that case, say you have an anticipation that say the market will definitely fall down to this point of time, and then again it will go up. So this is an appropriate time to buy. See, when you are referring the chart at that point of time, you do not see that say what is the financials of the company. You do not see that say what kind of industry in which it is pertaining. You do not see that say who is promoter of the company. You do not see that say what kind of policy that the government has with respect to that industry. You don't take into account any of these criteria, and just looking to this, you make a decision that say you should buy the security. This is given a name as technical analysis. Of course, we are going to understand a number of other techniques also in terms of the charting. Next question. Sorry. Uh, Going further, fundamental analysis. Fundamental analysis is based on assumption that the share price depend upon future dividend expected by the shareholders. Friends, apart from the dividend, it can be based on the cash flow, it can be based on the earning, it can be based on the assets, it can be based on the like price earning ratio, like that. So there are a number of other methods. The present value of the future dividend can be calculated by discounting cash flows at an appropriate rate of discount known as the intrinsic value of the share or fundamental price. The intrinsic value of a share, according to a fundamental analysis, uh, depreciates the true value of the share. That is the P0 which we were just discussing. A share that is priced below intrinsic value must be purchased, while a share quoting above the intrinsic value must be sold. So overpricing or underpricing. That is what we do even in the portfolio management, the equilibrium price. The same concept is required to be understood or it is required to be applied. Thus, it can be said that the price the shareholders are prepared to pay for a share is nothing else but the present value of the dividend they expect to receive on the share, and this is the price at which they expect to sell in the future. As a first step to arrive a compact expression, let us make a simple assumption that the company is expected to pay uniform amount of the dividend every year. Then in that case the P0 will be equal to D1 upon K. That is the way, so we compute the present value of the dividend. But it is unrealistic to assume that the dividend remain constant over the time. In most shares, dividend per share grow because of the growth in the earning of the firm. Most companies, as they identify new investment opportunities for the growth, tend to increase their dividend per share over the time. Let us assume that on an average, dividend per share of the company grows at the compounded rate G percentage per annum, so that the D1 at the end of the first period grows as D1 into 1 plus C, D1 into 1 plus C raised to 2, and so on. In that case, the P0 will be calculated like this. It is D1 upon K minus C, which is a perpetual geometric series. Perpetual stands for that say the amount of the dividend is going to be received by the investor for perpetuity. Friends, when I teach the chapter of the security valuation, at that time I explain even the derivation of the formula. So these formulas are simply simplification of certain like the equation, and when we do the chapter of the security valuation, in that so this formula derivation is also covered. This formula has a kind of explanation like this. Just listen the explanation. From end of year 1 onwards, for perpetuity, whatever dividend income that investor is going to receive, all that dividend income is discounted to year 0, that is called P0. Since D1 may be approximated as D0 into 1 plus C, D0 being dividend per share of the current period. When growth rate in the dividend G equals to or greater than the desired rate of return, K in the above model is not valid. So there is a basic assumption that the cost of capital will exceed growth rate, and practically it is always going to be like that only. Cost of capital cannot that is be less than the growth rate, because cost of capital is indicating the expectation of the equity shareholders. So they cannot expect less than the rate at which the company is likely to grow. Since the geometric series leads to infinite price, the condition G is be less than K is not very restrictive. Since the long-term growth in the dividend is unlikely to exceed the rate of return expected by the market on the share. The above result, equation 5, is also known as the Gordon dividend growth model. This is what something that say you might have studied at your second level, that is called like the dividend policy. That is the chapter. Stock valuation, named after model's originator Myron J. Gordon. This is one of the most well-known model in genre of fundamental analysis. In equation number 6, if the growth rate sets to be 0, we go back to the equation number 3. Means P0 is equal to D1 upon K minus C. In that, say they say that, say if at all the growth rate is 0, then P0 will be equal to D1 upon K. Dividend growth model and P multiple. The financial analysis tend to relate price to earning via price earning multiple, the ratios between market price and the earning per share. If a company is assumed to pay out fraction of B of its earning as a dividend on the average, that is dividend payout ratio is B, D1 may be expressed as B into E1. So E1 stands for the earning at the end of year 1, and B is what they have mentioned over here, dividend payout ratio. So multiplication of both of them is D1. EPS of the company at the end of the first period. The equation 5 will be like this. So this is D1, D1 into 1 plus E divided by K minus E is P0. The fundamental analysis uses the above models or some of their variations for estimating fundamental or intrinsic price or fundamental price earning multiple of a security. Friends, just I would like to tell you that the fundamental analysis is a very deep concept. It is not just restricted to the dividend. In the chapter that say we learn of the corporate valuation in mergers and acquisitions, we have the P0 to be calculated as dividend discount model approach. P0 is to be calculated based on the earning capitalization method. P0 to be calculated using the free cash flow for the equity method. Then P0 to be calculated based on the book value approach. P0 to be calculated using the chop shop approach. Like that, so there are number of methods that we have based on which say we can make the computation of the market value of the share. That is what we understand is a fundamental. And especially, friends, what happens at saying mergers and acquisitions, these kind of valuation methods are having more significant. Why? Because say those investments are going to be for the long term. Those investments are not going to be for short term. That is the reason say these valuation methods carry more importance over there. You cannot have the valuation just by say making some very absurd assumption. You need to have say certain quantifiable factors based on which you are supposed to do the valuation. Towards this end, they develop considerable effort in assessing the impact of the various kinds of information on the company's future profitability and expected return of the shareholders. So, friends, you can relate this point with the valuation of the goodwill, then valuation of the business that say you may be studying in your financial reporting, in which we understand that say we are having say certain points in this way that we can say that say the future maintainable profit is calculated taking into account say only the normal business. We do not take into account the extraordinary items. This is the way you can relate it. If the prevailing price or the price earning multiple of a security is higher than the estimated fundamental value, they recommend selling the stance with respect to the security. Since once the information becomes common knowledge, the price of the security may expected to fall. On the other hand, if the security is underpriced in the market, the prevailing price or the price earning multiple of the security being lower than the estimated fundamental value, they recommend buying, counting the upon a price rise. So we understand that, say, you can relate this point with the security market line concept of the CAPM. The security may be underpriced, security may be overpriced. If it is underpriced, everybody will buy, so the price will fall down. uh, Everybody will buy, the price will go up, and the price, that is security, will fall on the security market line. If it is overpriced, everybody will sell, and with that the price will fall down, and the security will once again fall on the security market line. So ultimately, the price of the security will be equal to its fundamental value. Because of this inherent complex interrelationship in the production process, the fortunes of each industry are closely tied to their to the other industries and to the performance of the economy as a whole. So basically the point says something like this, that for example, that say I am a company, say, which is providing IT solutions. When anybody would require the IT solutions, a logistic company requires the IT solutions when it has a business. So in that case, they require some automation. They require a certain software so to manage their business. So the business of the IT depends upon the business of the other companies. In which situation a logistic company will be able to get the business? When, say, a textile company is having a business in which, say, it is required the logistic services for the purpose of transportation. So this point says that, say, all the industries are one or the other way, say, connected to one another. Within an industry, the prospects of the specific company depend not only on the prospect of the industry to which it belongs, but also on its operating and the competitive position within that industry. So it says further that, say, in one industry, it is not that, say, all the companies are having, so, the uniform performance. We understand that, say, individually the companies are having, so, the different performance, and that we can very well see, say, with terms of the market share. We understand that, say, if at all you make a comparison of the, that is, say, the companies which are in the business of the, like, let us say, mobile manufacturing, in that, say, all the companies are not having, say, the same market share. The different companies are having different market share. What is the reason behind that? Say, they are able to, say, compete, or they are able to give better services to the customers. They are able to do some product differentiation. Or maybe, let us say that, say, a company called Tata or company called Reliance is entering into any of the new industry. Even in that case, they will be able to get the good market share, because, say, they already have, say, the good funds, because, say, they are having, say, other businesses with which they can support their new business also. So basically we are required to take into account all these factors at the time of making investment. The key variables that an investor must monitor in order to carry out his fundamental analysis are economic-wide factors, industry-wide factors, company-specific factors. In other words, fundamental analysis comprises of one, economic, second, industrial, and third, company analysis. They depicted by three concrete, that is, concrete circles, and constitute the different stages in which the decision making, investment decision making processes. This is what we understand. So basically, we are going to understand now economic analysis. In that, factors affecting the economic analysis, that we are going to understand. Techniques used in economic analysis. So in economic analysis, there are two things that we are going to understand. The first is the factors which are affecting the economic analysis. and the second, that which are the techniques which are used for the purpose of economic analysis. That is what we are going to have understanding. So you can see, that is, understand something like this. Let's say, like we know that there is no restriction for an investor to make investment even in the global market. It is not that say only you can make investment in National Stock Exchange or Bombay Stock Exchange. If at all you want to make investment in like the French stock market, you can. You want to make investment in the Europe stock market, you can. So like that, so the entire world is available to you, so for the purpose of making investment. So we understand something like this. Let's say suppose I want to make investment in, let us say that say one of the company which is doing business in Europe, or I want to make investment in Google, I want to make investment in Apple stock. Then before I make investment in the Apple stock, there are three things as per the fundamental analysis that I have to see. The first is say the overall US economy. The second is say the Apple is say in the like mobile manufacturing, or it is in the IT sector or electronic appliances, so that industry. And the third is that say I have to like look for the Apple stock valuation. So there are these three things that say I'm supposed to consider. Let us say that say I want to make investment in BMW, that is say the company say which manufactures BMW, or let us say I want to make investment in a company which is say manufacturing Audi car, that is say the Volkswagen. So before I make investment in the Volkswagen, I have to make investment, I'm supposed to do the research for say the economy of Germany, because say its head office is there in the Germany. The second, I have to make analysis of the automobile industry, and then I have to make the analysis for the Volkswagen car which manufactures the Audi car. So this is the way, there are three stages in which I have to make the analysis. That is what say the fundamental analysis says. And friends, in examination, definitely say these kind of questions can be there in examination, wherein the question of 4 marks can be asked upon, that which are the factors affecting the economic analysis. In that say you're required to write something like this. Then techniques used in the economic analysis. In that say you're required to write something like this. Of course, as we understand that say writing exact language is not required, but it is preferable. And certain keywords you cannot miss. Macroeconomic factors. Example, historical performance of the economy in past or the present, and expectation in the future, growth of the different sectors of the economy in future with the signs of the stagnation, degradation at present to be assessed while analyzing the overall economy. In simple language, suppose I tell you that say, let us make investment in a company which is having its head office in Afghanistan. Then apparently you will say that say no sir, I do not want to make investment. But that company is good. It has say the good product. But still you will have a point that sir, like a company which is having head office in Afghanistan, it is very difficult for that company to uh, compete with its say the its own country, because the political situation of that country is very unstable. So these are the factors which are required to be considered. A company which is say in there say it is there in an economy in which say they do not have say the good monsoon, then in that case again it is considered to be a limiting factor. So these are the things that you have to keep in mind. Trends in the people's income expectation reflect growth of a particular industry or company in future. Consumption affects the corporate profits, dividend, share prices in the market. Factors affecting the economic analysis. Some of the economic wide factors are discussed below. Growth rate of the national income and related measures, growth rate of the industrial sector, inflation and monsoon. So again, all of you definitely understand that say this head points are very necessary, and in that say you can write something which is related to the head points. For most purposes, what is important is the difference between the nominal growth rate quoted by the GDP, that is gross domestic production, and the real growth after taking inflation into account. We understand something like this. Let us say that say the 15% is the normal growth rate, and let us say that say the inflation is 6%. Then the real growth rate will be found like this: 1.15 divided by 1.06 minus 1. So the real growth rate is 8.49%. This growth rate takes into account the changes of the price, which is not the real growth. The change in the production units is what we understand is the real growth. The estimated growth rate of the economy would be pointed to the prospects for the industrial sector. Therefore, the return investor can expect from the investment in shares. Growth rate of the industrial sector. This can be further broken down into growth rate of the various industries or group of the industries if required. The growth rate in the various industries are estimated based on the estimated demand for its products. Inflation. Inflation is indicating the rate at which the price changes of the same commodity or same services. Inflation is measured in terms of either wholesale price, that is wholesale price index, or a retail price, that is called consumer price index. The demand in some industries, particularly in consumer product industries, is significantly influenced by the inflation rate. Therefore, the firms in industries make a continuous assessment about the inflation rate likely to prevail in the near future so as to fine tune their pricing, distribution, promotion policies to the anticipated impact of the inflation on demand for their products. Monsoon, because of the strong forward and the backward linkages, monsoon is of the great concern to the investors in the stock market too. So good monsoon will definitely support number of industries, and poor monsoon will have the like adverse effect, say that is on the economy as a whole. This is what we understand. Now different techniques which are used in the economic analysis. Economic analysis is used to forecast national income with its various components that have a bearing on the concerned industry and the company in particular. Gross national product is used to measure national income as it reflects the growth in the future, so growth rate in the economic activities, and has been regarded as forecasting tool for analyzing the overall economy along with the various components during a particular period. Some of the techniques used for economic analysis, that is we want to analyze the economy of US economy, we want to analyze the economy of like let us say Germany, let us say Pakistan, let us say Burma, something like that. So it is anticipatory survey, barometer or indicator approach, economic modeling, bundling approach, that is a building approach. These are the three approaches that we have. They help investors to form an opinion about the future state of the economy. It incorporates the expert opinion on the construction activities. See, basically, the construction activity is considered to be, say, one of the like an indicator that say the industry is likely to grow, because we understand that say when anybody would make investment in the infrastructure, somebody would make investment in infrastructure when they are very hopeful say about the future. Expenditure on the plant and machinery, so it is going with the like the we understand capital investment, levels of the inventory, all having a definite bearing on the economic activities. Also future spending habits of the consumers are taken into account. In spite of the valuable inputs available through this method, it has certain drawbacks. So, friends, number of times it is considered like this. Uh, we know that, say, like if at all we talk about, let us say, the year 2000. In the year 2000, whatever the rate at which the internet was used in India, and let us say that, say, United States of America was different. Let us say that I am talking about year 2000. Uh, by now we can say that, say, the rate at which it is used in United States of America and India is like this. Means at this point of time, anybody can forecast that, say, the India is likely to follow the United States of America, and in future, say, they are going to have something like this. Similarly, we can say that, say, there are number of changes, say, which take place. Let us say that, say, we talk about the packaged food. Then the packed food is not something which was very much famous earlier in India. Everybody was, say, buying the like loose product only. But still, if at all we take into account that, say, how it is used all over the world, so that kind of future that, say, we may have even in India. That is, say, the coming time. Or we can say that, say, the electronic vehicle. Um, we are reading every now in the newspaper that, say, there are number of companies, say, which have even stopped or they are going to stop in very near future manufacturing of the petrol or the diesel car, and they are going to, say, manufacture the electronic vehicles. Why? Because, say, that is the future. In the year 2022, say, what is going to be there in 2030, what kind of requirement will be there, based on that, say, you do something today. We understand that, say, the kind of situation which Delhi is facing, wherein, so the uh, like the pollution, the level of the, that is air pollution which is there in Delhi is substantially high, and because of that, say, they have restricted the number of vehicles that you can own, then or even something like that. So that kind of situation is anticipated by other, like the states also, and on a precautionary basis, say, they would like to move into electronic vehicle so that, say, the air pollution can be restricted. So keeping this into mind, so this is what where the business is going to be there. You can do certain actions today. That is what, say, they try to explain us over here. Uh, yeah. In spite of the valuable inputs through this method, it has certain drawbacks. Survey results do not guarantee that the intention survey would materialize. They are not regarded as the forecast per se, as there can be a consequence approach by the investor for exercising his opinion. Continuous monitoring of this practice is called for to make this technique popular. This is very much acceptable, the drawbacks that they have provided. Barometer or indicator approach. Various indicators are used to find out how economy shall perform in the future. The indicators have classified as under leading indicators, roughly coincidental indicators, and lagging indicators. Leading stands for leader. So we come to know before. Okay, these are the indicators, because that is because of that, say, you take some actions prior. That is leading indicators. Coincidentally, you did something, so that happened to be a good business opportunity. Lagging means, say, later on you come to know. They lead the economic activity in terms of their outcome. They relate to the time series data of the variables that reach high-low points in advance of the economic activity. The term time series data is something that, say, you have studied in your foundation. It says something like this, that what you are going to take into account is the past results, and based on that, say, you are making some anticipation about the future. That is what we understand is the time series data. They reach their peaks or troughs at approximately the same in the economy. They are time series data of the variables that lag behind their consequences vis-a-vis the economy. They reach their turning points after the economy has already reached its own uh, has reached its own already. So this is what say we understand is a kind of like the barometers or the indicator approach. All these approaches suggest direction of the change in aggregate economic activity, but nothing about its magnitude. The various measures obtained from such indicators may give conflicting signals about future direction of the economy. To avoid this limitation, use of the diffusion of the complex index, composite index, is suggested, whereby combining several indicators into one index to measure the strength or the weakness in the movement of the particular set of the indicators. Computation of the diffusion indices is no doubt difficult, notwithstanding the fact it does not eliminate irregular movements. So we can say something like this, that again, if at all we go back, say before 10 years or 15 years or 20 years, then online shopping was not something which was very like a new idea. But at that point of time, say somebody started that, say the business, and that business may have become very successful, that company, for that company. That is what we understand is that, say uh, they have made a forecast that said this kind of like the consumer's pattern will be there in future. So that is what we understand is, say you make a forecasting that say what kind of situation will be there in future, and accordingly you do something today. Then we understand that, say similarly in the social media platform also we have say certain things like this. So you make a forecast and accordingly you take a business opportunity today. The second thing is that, say certain events have already occurred, and then you think that, say there is a good business opportunity. Let us say that, say the COVID-19, after that, say you feel that, say now the people will be more health conscious, so you start some business, say which is say becoming popular, or you try to take that advantage of the business, say of health sector. That is what we understand is the lagging indicators. Leading means, say you take the business opportunity, say before that say kind of situation comes. Money supply in the economy also affects the investment decision. Rates of change in the money supply in the economy affects GNP, corporate profit, interest rate, stock prices. So all these things actually you can relate with the systematic risk that we study in portfolio management chapter. Increase in the money supply fuels inflation. So number of, say the bail-in packages, say which are introduced, as investment in the stock is considered as a hedge against the inflation, stock prices go up during inflationary period. Friends, over here they mention that, say when you make investment in the stock market, then in that case, say you will be getting a return over a long period of time, which is say going to cover up the inflation. Economic model building approach. So this economic model building approach is a kind of like you will be having say certain equations to be used for the purpose of say making estimation that how the economy is going to grow. So certain like the weights will be given to the different parameters, and based on that say you derive say certain like the uh, estimation about say how the GNP is going to grow. In this approach, a precise and a clear relationship between dependent and independent variables is determined. Okay. GNP model building or sectorial analysis is used in practice through the use of National Accounting Framework. The steps used are as follows. So over here, these are the steps that they have provided. Hypothesize, hypothesize the total economic demand by measuring the total income based on the political stability, rate of inflation, changes in the economic level. forecasting the GNP by estimating level of the various components, namely consumption expenditure, gross private domestic investment, governmental purchase of the goods or services. After forecasting individual components of GNP, add them to obtain the forecasted GNP. Comparison is made of total GNP, thus arrived at that form an independent agency for forecast of the GNP, and then overall forecast is tested for that is consistency. This is carried out by ensuring that both total forecast and the component wise forecast is fit together in a reasonable manner. This is what we have is a kind of in total about the economic analysis.